of strategy at Delenta. In my previous career, I was a venture capital investor, and I did 25 investments in early stage technology companies across the UK. In that time, we achieved some exits in the portfolio, and I've seen the good, the bad, and the ugly of how to do an exit properly. The objective of this webinar is to make sure that you don't have an ugly experience. Okay, a little bit about Delenta, who are hosting this platform for us. Delenta is an award-winning global coaching platform. It helps coaches from small solopreneur businesses to large corporates to run their coaching programs. It will do everything for you, from multi-coach capability to handling all your GDPR or your security concerns, do all your invoicing, all your reporting, or your scheduling, protect all your assets. And we are basically a tech partner for you to grow and scale your business. So very quickly, I'm going to pass over now to Jo Haigh. Jo Haigh is the chairperson and founder of FDS Financial Consultancy Services. Jo has a very long history. She's sold over 400 companies in her career. So over to you, Jo. Tell me a bit about yourself.
Thank you for inviting me here today. So yes, my business is actually 35 years old this year. And as Julian said, over that time, we've been involved in over 400 transactions. We almost exclusively work on sell side for owner managers. And we always said, well, we are an owner managed business, so we understand the psyche of those. 4 years ago, I actually transferred the ownership of my business to my staff in something called an EOT. That's an employee ownership trust, which will be something that we'll be talking about along the way of these events.
Yeah, I think, Jo, that's becoming a really popular way, isn't it, to transfer business ownership in a where value can be retained and you make sure it's going into the right people's hands.
Yeah, I mean, to me, it was very important. And for a lot of owner manager founders, the DNA in your business is particular to that organization. And whilst I could have sold my business to any number of organizations, the people in the business are the magic. And an EOT is wonderful for keeping that magic intact, because if you sell to a great big organization, you're almost certainly going to be swallowed up by those. And it's extremely tax effective for the owner. As you'll hear later, the owner doesn't pay any tax at all, unless our friend Rachel Reeves might get hold of this, I guess, at some point. It's also much quicker to do. It's much cheaper to do, but much more of this later. But it was very important for me. We're a very unusual company in my sector. We're an all-girl team. We're from Yorkshire, so it makes us very straight talking. We're highly efficient, and we are fun to work with. In fact, the values in my business are be kind, work hard, stay positive, have fun. And those are not necessarily KPMG's values. So another reason why we wanted to keep it within our own sort of little bubble.
Oh, that's fantastic. And they're great values to have and very easy to remember and nice high level. Everyone can recount those values, I'm sure, and live them in the business.
They do. They do.
Absolutely fantastic. We've got 30 minutes to pack full of all this interesting content. So the subject we're going to talk about is called Valuation Methods, Myths and Pre-Sale Grooming. I'm going to cover a number of topics. The first one being, who are the different buyers you're going to sell to and what are their different values? And what are you actually selling? Who values what in the business? We're going to talk about providing financial information like cash flow and your profit forecast, and talk about technical valuation methodologies. What systems should you use and how do you use it? And how do you deal with excess working capital? And finally, we're going to talk about a thing called normalization. Well, what the heck is that? So let's find out. Let's dig right in. So, Jo, let's talk about the first question. Tell me about who are the different buyers and what are their different values?
Okay. Tends to be a thought process that goes through a vendor's mind that you're going to sell to somebody like you. So it's going to be a horizontal sale. Actually, that may not necessarily be the case. A vertical sale can work just as well, whether it be to a supplier or a customer. So that's the first one, which is like a trade sale often. of course, it could be to an international party on the same basis, either vertical or horizontal. It can be to the management team, and you may have heard of the management buyout. And the problem with MBOs is that often the team that are doing the deal are the directors and sometimes even shareholders, and that can create potential legal conflicts which are difficult to manage. Also, there's this belief that, well, I've built this business and now you're asking me to pay for what I've built. Also, management teams rarely have money, so that can make it also more of a challenge. Although banks tend to like management teams, they actually prefer bimbos. That's not a blonde, by the way. That's a management buy-in, buy-out, where you bring an external party to join the management team who may have money or contacts, but it's just strengthening the positioning of, we've got extra expertise and understanding to match our great management team. And ever increasing in popularity is, another acronym, which is a VIMBO, which is a vendor initiated management buyout. And that can be much more friendly, shall we say, because all the parties are working together, usually with the vendor covering the costs of the advisory team and working together to get a fair value and a fair deal structure. Of course, you can sell to much bigger businesses than you are, and you might think that that would get you the most money, and it might do. But very large businesses are very difficult to interest in more modest sized businesses, because it's the same time and process to get those transactions over the line. And they usually have got teams of lawyers and advisors, and they're doing this all the time. And maybe, you're only doing it once. I remember once selling a builder's merchant to Travis Perkins, and a family owned business. And Travis Perkins have got a whole M&A department because they're doing 2 or 3 deals a month.
Wow. Didn't know that. Yeah.
And then when you've got just a small owner manager, it's like they're overwhelmed with all these people.
Absolutely. It is overwhelming because you have to learn on the process, really. You only do it once in your life, probably.
For most people, it's once in life, often talking a language that you don't even understand.
Yes, absolutely. Yeah. Lots of acronyms.
And God help us if you get lawyers involved.
Oh, heaven help us. Yeah. It will get very expensive very quickly.
Absolutely. And we will be talking about managing, the advisory teams later on, and what to expect and how to negotiate on their fees.
Yes,
and then, of course, there's the EOT, which I mentioned earlier, which is what I've done, where you transfer the ownership of the business into a trust that owns the shares on behalf of the staff. So the staff don't own them individually in the same way that they would do in, say, a management buyout. It's a bit like John Lewis is probably the best example of what an EOT actually is. There's still only less than 2,000 in the country, bearing in mind there are 6 million businesses, is still not really understood or valued. In fact, when I talk about this at an event, I'll have people in the audience going, that can't be right. That's too good to be true. So I go, well, actually, I've done it. So, I know it works.
Yeah. So how do you get your value out of the business, Joe? How do you get money out of the business?
On an EOT?
Yes, on an EOS, yes.
So there's a complicated process, not as complicated as finding an external buyer, but you've got to have an external validated valuation that's approved by HMRC. You've got to set up a trust company. You've got to have independent trustees on that. And you can, I haven't, and all the transactions we've done on EOTs, none of my vendors have done this, but you can borrow the money, or the company can borrow the money and lend it to the trust to pay out the vendors. But I never wanted to do that because we never had any debt. And it's the same with most of my clients. They haven't had debt. So, and then you agree a payment plan. But because you're taking this money tax-free, so I always took a salary, which I still do, but I also used to take a dividend. I don't take a dividend now. I take a capital drawdown, 100% tax-free. Okay. So that's how you get your money out. And I still want it to work. Most of the vendors that I've been involved in have stayed on to work. A few have stood back completely. You do have to have a good management team, and it can't it can't be just about, oh, yippee, I'm a vendor, let me get my tax-free money out of here. You've got to have valid reasons for doing this. It's about creating a legacy business. So you've got to put forward a statement to HMRC to say, this is why we want to do it. And again, I find most owner managers, going back to what we said about the DNA, this is their baby, their passion.
Absolutely, and they want to see it in good hands, right? And sometimes when you sell a business, as soon as the deal is done, that's just the beginning of the hard work of integrating all the processes and the staff and the cultures. And to make that successful, it's more likely to succeed through an employee ownership trust.
Yeah, that isn't to say that trade sales don't work, but very often on a trade sale, particularly in consultancy business, there'll be some sort of earnout. And I suspect many people in this audience will be unemployable. I certainly am unemployable. You've been so used to working for yourself for so long, to then have to work for somebody else is a massive challenge. And so often those are not quite as successful as they might be. So one argument that we'll hear from vendors who are considering all these options, well, we might get a better price from a trade buyer. And yes, you might. You absolutely might, because you can create like a competitive tension between buyers, but you're going to have to pay tax on that. And Rachel Reeves is not going to bring capital gains tax down. I can absolutely assure you.
Going up, I think. Yeah.
Also, it's going to be more expensive and take longer to do. But not all businesses are suitable for EOTs, because you've got to have a management team. I mean, I've got a fantastic management team. So I'm not saying I'm not needed in the business, but I'm certainly not needed all the time. And they've got to believe in the business and trust in the business. So though all those different types of people have different types of values, but it's never just about the numbers. I remember selling a foster care agency, and we'd valued this business at about 3.5 million, and we had 17 bids, which is phenomenal really for a private company sale. And they ranged from 800,000 to 5.5 million. Wow. So the 800,000 were the tire kickers. Most were around the 3.5 million. The 5 million plus was as follows. I'd had a negotiation meeting with these buyers who were not in the business, and foster care agencies work on regions that you get a license for, and these particular people wanted to be in this area. And typical car park conversation on the way out was, Joe, I really, really want this business. What do I have to bid? I thought, okay, begin with a 5 and you're probably in the running. And that's exactly what they did. And that was nothing to do with the numbers. It was to do with the buyer wanting that business and nobody else wanting to have it. I mean, I don't know if there's any eBay buyers here, but I've got a garage full of stuff that I don't want, but I didn't want anybody else to get it either. And so it's this sort of stirring of, oh, I've got to have it.
Okay, let's get stuck into the next question. So, Joe, can you advise people? We need to know, what are you actually selling, and who values what in the business?
Okay, so the way to make your business as valuable as possible, no matter who the buyer is to make yourself the least most important person in that company. The more valuable you are, the more likely that you'll have to stay on. Now, that's not necessarily a bad thing, because if it's some sort of earnout, as long as it's managed properly and you see the earnout as jam, in other words, if it all goes wrong, well, at least you've got the bread, it's okay. But relationships are often very challenging after a transaction. So if you can demonstrate that you are not needed in the business other than in a strategic point of view. I mean, I don't run our business at all, and I haven't done for years. My CEO runs the business, and that's why I could have sold it to other people, because the team would have been valuable. But if it was still Joe Haigh, that makes it more challenging to sell. So that's the first thing you're selling. The other thing that you're selling is what we call hidden assets. What is it in your business that's beyond the numbers? And I can remember selling an online florist, and we sold it to an online gift company because they wanted the 2 million people who were on their register. They didn't care about the numbers. They just wanted to sell to that list. tips, if you've got more than 20% of your business with one client, that can change how people perceive the risk to be. So keep those percentages as low as you possibly can. Have good contracts in place. Automatic renewals, brilliant. No anti-innovation clauses, change of ownership clauses. All those things add value. I've sold very, very unprofitable businesses. And I remember one business, there was a solvent company, £10 million turnover business, making £1 million loss with an insolvent balance sheet. And we sold it for £6 million. And the reason was that the buyer bought it to take them out of the market because they were a specified product in the industry. And they just closed it, took all the plant and moved it to them. There's nothing to do with the profitability of it. So think about what are those hidden values in your business. It could be your database, it could be a special
that it's those hidden values, and can you put can you quantify those, right? And rather than be an amorphous blob, can you quantify and put value on those assets, the IP, the particular way you coach, the methodology, something proprietary?
Yes, your relationships, your long-term relationships with people, the referrals, things that are not necessarily
the intangibles. Like the brand reputation.
I'm just going to say the brand
reputation is very important. The reviews online that you might get, the perception of the business, these are all really, really important things.
And those, because unlike selling a property, for instance, we don't put a value on it to the external parties, but we do talk about the potential. So even if this stuff that you haven't done because you haven't got the finance, if you can talk about what I call the sizzle, not the sausage in the pitch.
Sell the sizzle.
Sell the sizzle. What is it that is exploitable? It's you just haven't managed to do it. So those are the things that make a huge difference to people.
Absolutely. I think to look at it, put yourself in the shoes of the buyer. Why would they buy your business? How does it strengthen them, give them a better competitive edge? Put yourself in their shoes and look at your business. And I think you should also go through the whole preparation of preparing your business for sale. It can take months or even years sometimes. It's a great process to see the weak points of your business as well and prepare yourself.
I actually always say, unless you're creating a long-time legacy business, you should think about what your exit route is from day one. So your systems are massively important, because nobody goes into a data room and goes, oh, so much better than I thought. Do you want more money? That's never happened.
Never happened.
That's never happened. They're always, and depending on the size of the businesses, you can have a pre-sale due diligence exercise done. It's a bit like, do you remember when they introduced, I think it was called HIPS, where they came in and did a survey of your house?
Yes.
A bit like that.
Yeah.
But it's not necessary, but get an independent person to have a look and go, well, that's going to be a challenge.
Yeah. What about how careful you've got to be? Just popped into my head. Say a competitor comes along and is interested to buy your business. You've got to be quite careful about what information you give them.
So NDAs, of course, we have all in place, but we always pitch our sales documentation as that the vendor is looking for investment. That's much less scary than we're looking to sell. Also, I can buy Nigella's cookery book. I can't cook. So however much information, and there does become a point where you have to give a certain amount of potentially sensitive information. But if you believe in your business and your people, then don't be worried about it. If somebody's so keen to get all your recipes, let them have it. They're not the chef.
I remember back in my investor days, people would always be overprotective of their ideas. Like people copy this idea, but it's just not the case. It's all about the execution.
Absolutely.
Ideas are to a penny, right? It's all about the execution.
I completely agree. And this is all this magic in owner managed businesses that isn't easily replicable. It looks it, but then you've got to deliver it. Because so many business, particularly consultant business, are all about personality. And we when people ask what we sell, we sell confidence, assurance, fun. That's what we're selling. We make people millionaires, but it's that atmosphere, and that is what's unique to us.
Fantastic. That's a great segue to talk about a bit more of the finance side now. So providing the financial information, the cash flow and the profits, what do you need to do?
So unfortunately, lots of smaller businesses, they don't produce monthly management accounts. You need to address that, because a deal is going to take at least 9 months from inception to completion. And it's no good saying, well, I've got my year-end accounts and, you'll have to rely on that, because they won't. You've got to have monthly information. So it's worth the investment in that. It's also important not just to look at profit and loss account and balance sheet, but also what cash are you generating? Where are you spending it? Savvy investors will be looking, where can they make more money? So we might do an exercise like, what are your debtor days? How quickly are you collecting your money, and what are your creditor days? How good are your payers? As for forecasts, I would say be careful with forecasts, because if you forecast a hockey stick performance and a buyer buys into that and they say, right, it's an earn out, and you go, oh no, I don't want to do an earn out because not sure I'll do that. But you gave me those projections. So if you over egg that, you will be stuck. So what I usually do is I'll usually do best case and medium case.
Okay.
And we'll go, because then that gives you a little bit more leeway.
Yeah.
Don't over egg it all. On the other hand, though, you can't undersell it. It's a difficult one.
You create a rod for your own back, won't you?
Yeah.
Basically,
So
yeah.
Up to date financial information, massively important. That's regularly available, because as soon as you get people interested and they're going into either a pre-data room arena or in the data room, they want it now.
Yeah, they do. Yeah. And you need some professional help probably to get all that in order and looking the way it should look.
I think one of the downloads I've got is a due diligence data room checklist, which is 30 pages long.
Yeah, frightening.
Because you've got a business to run at the same time as populating that data room.
Yeah. So let's talk about technical valuation methodologies. Many methods of valuing a company. Which ones are the most popular that you've come across or has used?
Okay, so at the end of the day, a private company is worth what the vendor will sell at, the buyer will buy out, and how they're going to raise the money. That is the start point. And while I don't like to align myself to an estate agent, in many ways, you are selling an asset that could be your house. And I'm sure there are people in this audience who will have sold a house and they'll have had an estate agent, maybe 2 or 3 estate agents, giving them different values. Almost certainly going to choose the highest, the one that gives the highest. And then maybe nobody buys it. Maybe somebody offers much less. Maybe somebody offers the money and then they can't get a mortgage. Or maybe the buyer that comes round, this house is next door to their best friend in a catchment area for the best school in the area. And somebody else comes and they don't know anybody there, and actually they haven't got school children. So the value to those people is entirely different. So in terms of a value, that's the start point. However, I would always recommend you have a technical valuation, because both sides will have done a technical valuation. And there are many different ways. It depends on the industries. So where you've got a lot of recurring income, it would be on multiples of recurring income. So IFAs, for instance, are anything between 1 and 3 times recurring income. If it's a business that's got lots of assets, it would be net assets plus goodwill, and that's more magic.
Yeah.
If it's a profitable ongoing business, it might be a multiple of normalized EBITDA, and I'm going to talk to you what normalized means later on.
Yes, we will touch on that. Yeah.
And the reason why you do that is you wouldn't, unless perhaps you're a bit green, just put your house on the market and ask for offers, having no idea what it was worth. So it gives you a start point, and it's also likely that the buyer will have done something. So you're coming into the room, both of you, with at least an idea.
Yeah. So a baseline, basically, of where it should be on a technical basis and adding the goodwill on top.
And there is some downloads on this as well, but I also wrote a book called The Entrepreneur's Guide to Buying and Selling Businesses, and there's a whole chapter on how to value a business. But what you've got to remember is it's a valuation. That's not the same as worth.
Yes, that's right. And that's where goodwill comes into play, right? So goodwill consists of things like brand reputation, IP, intangibles almost. Yeah.
Goodwill could be anything. It could be, a technical method. It could be that you've got the best rocket scientist in the world as your consultant. It's like beauty. Coming back to the house next door to the best school in the area. That's not worth anything to me. My children are grown up.
Yeah.
But it's worth something to somebody else. So that's why it's important to find that match between the buyer and the seller and what they both want.
Great. So if you've got a great business humming along great and you've got a lot of excess working capital, how do you actually deal with that part of the business?
Okay. So the word to note there is excess capital. Excess. So every business needs to have some working capital left in it. Now, what that working capital amount is very, very difficult to quantify. There is no financial equation to calculate excess working capital. There's a financial equation to calculate working capital, but not excess. So if you are in a business that's very seasonal, it could be completely different in November to what it is in March. So when you're selling your business, but most offers come in on what's called a cash-free, debt-free basis. Now, debt-free is easy. What is interest-bearing debt that we need to take off there? But cash-free could mean anything. So one of the first things we always do is we agree how that is going to be defined, and it's written into the heads of terms so that both parties know this is the method of calculation of this. And that saves lots and lots of hassle at the end. And you'll often get buyers, particularly savvy buyers, going, oh, we'll sort that out later. No, I don't think so. We want to know what formula you're using now. And of course, at the moment, dependent on what happens in the budget, you take that out under business asset property relief. So on the first million, you pay 10%. On the rest, it's 20%, including your excess cash. But I don't know what's going to happen.
No. So there could be a rush of sales happening if these new rules come in.
It'll probably be too late.
Tax grab. Huh?
It'll be too late if she brings it in straight away.
Or she brings it straight away. Yeah, absolutely. But if not, you could be very busy.
Or not.
Oh, no. Can you expand a bit on for our viewers about what working capital actually means?
So working capital is the difference between current assets and current liabilities. So current assets are things like your debtors, your work in progress, stock, any cash in the business, and current liabilities being creditors, trade creditors, HMRC, PAYE, that sort of stuff. A good business, in terms of a financial analyst, should have twice as many current assets to liabilities. It's called a current ratio. Okay. Of course, many businesses don't have that, but that would be a good solid position from an investor's point of view. But working capital is the money that you need to run the company on a monthly basis, to make sure you're covering the wages, to make sure that you're covering the rent, the rate, the heat, the light, all your fixed costs. So that's going to vary tremendously from company to company. And you can see in a seasonal business, if we sold a toy importer years ago, and of course they needed all their cash to buy the stock in spring, ready to sell over Christmas. And then when it came to January, don't need any cash because sold it. So I can't tell you how to calculate it, but I can tell you that when you come to getting an offer, you must get that right. Okay. You must get that definition right.
Okay, great. So let's dovetail into the last subject, which is normalization, Joe. And that's another technical term that you can perhaps help our viewers understand.
I mentioned very briefly normalized EBITDA. So EBITDA is earnings, which is profit, before interest, tax, and amortization. Amortization is just a posh word for the reduction in value of an intangible asset. And that's what most private businesses that are profitable are technically valued on. However, most owner-managed businesses put certain costs through the business that would not occur if it wasn't owner-managed. So they might have spouses or children on the payroll, for instance. They might have expensive membership of clubs and so on. They might travel business class. So normalization is adjusting that EBITDA line to take into account what would be either discretionary or non-recurring costs. And one thing I would recommend to this audience is, if you are planning on selling, start tracking those on a spreadsheet, broken down into, this is a one-off cost. We've done a complete rebrand, or we've relocated our offices. We won't be doing that again for a while. To, I always travel business class and I need to take my children off the payroll, because obviously they're on the payroll now, but they won't be when I've sold the business, and keep a track of all that. And it needs to be auditable. So it's no good just throwing through numbers down. You need to be able to track it. So that restated profit, and it can be higher profit, but of course it could be less. Say you were just taking a very small salary and paying yourself lots of dividend, then you have to normalize it back. But if you've done what I've said at the beginning, which is make yourself completely dispensable, we just remove all your costs.
Yeah, absolutely. Yeah. Fantastic. Joe, thanks very much for that fantastic advice. It really does reflect all your years of experience, and that you can pass this on to our viewers. A lot of them are owner-managed businesses in the coaching field, and I think they'll take a lot of value from what you've been saying. We'll have another 2 webinars coming up, but Joe, many thanks for your time, and I look forward to talking to you on the next session.
Thank you. Thank you very much for inviting me.
You're welcome. And thanks everyone for watching. Yeah, fantastic.
Take care, everybody. Bye-bye.